Well, good afternoon, everyone. This is Chris Kaufman with the law firm Frost Brown Todd. Appreciate everyone taking the time out of, I'm sure it's a busy day, to spend a little time talking about a topic that's near and dear to my heart. Hopefully something that obviously you all are interested in as well, by taking the time to participate in this webinar. I really want to thank Charles Tassel and his efforts to organize this and put together an educational session for the National Real Estate Investors Association, and we're honored to participate and be available to provide a little bit of education information I hope will be useful to your business and your investment decisions, and working with clients or on your own behalf. Would ask, as we go through what's going to be some dense material that I'm sure will generate some questions. I know there's a lot of disconnect, there's a lot of disagreement out there in what people are saying and offering as instruction, and so I'm sure there's going to be questions. I want to save some time at the end of the presentation, about 30 minutes, for that discussion. So if we could just hold questions until after the presentation, that would be great. I think it would make the presentation go a lot smoother, and then we can address those questions at the end. To the extent that you have questions that arise and you don't want to forget them as we're going through the presentation, I believe there's a function within the webinar mode that you all have logged into the module, that you can enter in a question, and that question, then you type it in, it will come to me and I will see those, so that you're free to ask those questions, type them in, and they'll be available for me to address and discuss at the end of the presentation. Just to give you a brief background about myself and Frost Brown Todd, I am a tax attorney by trade. I've been involved in tax planning and civil tax controversies, audit, litigation, for about 20 years now. That's been my practice. So the ability to plan, work with taxpayers, and looking at ways that we can make their business activities, investments, most tax advantageous as possible. That's kind of been my expertise over the period of my career. And so as tax reform was passed in end of 2017, I was, as many tax attorneys and accountants and business people, neck deep in the changes and trying to understand and affect and wade through all of the different issues. And we, in that process, identified kind of a forgotten at the time or overlooked piece of tax reform. There's a lot of other issues at the time that were much more pressing and had a much more significant impact on businesses that got most of the attention in that initial discussion. But one of the areas we identified very quickly, and others did as well, as being an area that would be of importance and would be of getting a lot of attention as opportunity zone tracts were selected and identified and the process moved forward. We would have definitely a need for people to be up to speed and on top of the issues. And so that's kind of been my world since at least the opportunity zone tracts were designated, that process, being involved in selecting them at the state level, and then the designation by Treasury back in June of 2018, and then digging through the guidance that's come out over the last several months, working with clients to understand how those can be implemented. We have a multidisciplinary team here at Frost Brown Todd, given all the different areas that Opportunity Zone programs, development activities touch on, M&A, corporate, securities, tax, real estate, financing. We have a full team that works together to work with clients both on the investor side and on the business and developer side to move projects forward across our 8-state footprint and beyond. So just to give you a little bit of background on who we are and what we do, we've been involved in a number of different Opportunity Zone Fund projects and putting funds together, advising investors, advising businesses, advising fund sponsors, developers, municipalities, states. We've been involved on all levels trying to provide guidance in this exciting tax incentive economic development program. So without further ado, again, I really appreciate you being here and taking the time, and it's an honor to work with you and your group, and so we'll move into the presentation. As touched on briefly, the Qualified Opportunity Zone Initiative was enacted as part of the sweeping federal legislation at the end of December of 2017, commonly referred to as the Tax Cuts and Jobs Act of 2017, or tax reform in a broader sense. As you may remember, and as you've likely experienced in your businesses, it impacted taxpayers at a variety of different levels. And again, this piece of the legislation was essentially the lone bipartisan piece that was championed by both Senator Scott from South Carolina and Senator Booker from New Jersey as a program focused on incentivizing and encouraging private investment in low-income communities. It had been lingering through discussions in the legislative process, different scenarios, different forms, but as tax reform began to move forward at a rapid pace, you had an opportunity for this program to become a part of that sweeping legislation and get passed. So in the Tax Cuts and Jobs Act, you have the creation of two new sections of the Internal Revenue Code, sections 1400 Cap Z-1 and section 1400 Cap Z-2. 1400 Cap Z-2 is the primary section that we deal with in evaluating the different incentives, the structuring requirements from a statutory perspective. And what that section provides is that for taxpayers that are willing, able to access unrealized capital gain, tap into appreciated assets through which the disposition of those assets would generate capital gain, there is a incentive and tax benefit to recognizing that gain and reinvesting that gain into qualified opportunity zones who are investing in businesses and property located in opportunity zone tracts across the country. Just a little background from the legislative perspective and from the guidance that we've had. This program was initiated as part of the Tax Cuts and Jobs Act in December 22nd, 2017. You had a lag period as local jurisdictions were tasked by Congress. Basically, the executive branch in each state had the obligation to identify at least 25% of their low-income census tracts. These are tracts, if you have any familiarity with other types of tax incentives or tax credits, such as low-income housing tax credit, enterprise zone, they rely on these low-income census tracts identified by the census data with certain median income levels and poverty levels. Those tracts were defined, they were known. So Congress decided let's don't reinvent the wheel. Let's focus on these identified areas. And each state has the ability to nominate essentially up to 25% of those low-income census tracts for designation as qualified opportunity zones. So following the passage of the Tax Cuts and Jobs Act in the original statute, you had states working with local jurisdictions, with economic development agencies to identify, what portion of those tracts would be nominated for consideration to Treasury to be designated as opportunity zone tracts. So that's why, as you look across your various jurisdictions that you are familiar with, you'll see certain tracts that were designated, certain tracts that weren't. Not all of the low-income census tracts could be designated. Again, there was a cap of 25% in each state. So you had, an evaluation and an analysis that had to be done by each state to identify, from their perspective, what were the most attractive and deserving and investment-ready tracts to be nominated for consideration by Treasury. So that process ended in June of 2018. Those tracts are set. We know where they are. They're not going to change. Their designation lasts for a period of 10 years. And, you have a variety of ways to access where those tracts are located, whether certain properties or addresses or businesses that you're looking at or identifying are located or operating within them. But those areas are designated and those boundaries are set. We know where the space is that we're operating in, and it's been identified. One of the problems, though, following that process is we had essentially one statutory section, very limited and general, offered not a whole lot in the way of guidance. And so we were depending on Treasury as we tried to move projects forward once the opportunity zone tracts were designated by Treasury. We're depending on Treasury to provide additional guidance as to how the statute should be interpreted and applied. We got our first round of guidance October 19th of 2018, and the first set of proposed regulations issued by Treasury. Those proposed regulations, in addition to a revenue ruling that the IRS issued, provide some basic clarity, some foundational understanding as to how the IRS and Treasury would view the interpretation and enforcement and application of the Opportunity Zone statute. We were able at that time then to work to structure some deals, primarily on the real estate side, because most of those transactions were fairly straightforward, and we're able to move forward in working to put deals together that we thought were consistent with the proposed guidance and the statutory language, but still had some questions about a variety of issues that were unanswered in the first round of regs. Thankfully, last month, April 17, 2019, Treasury issued a second round of proposed regulations that gave us a significant amount of additional guidance, substantially more broad in its scope than the original regulations, and answered a lot of questions that had been relatively unanswered after the first round. So we definitely at this point have a lot more guidance than we initially had, have a substantial amount of guidance to put deals together and move them forward. There still are some open issues that we're hoping through the public comment process on the second round we'll be able to address, and Treasury will be able to provide some additional clarity. But that process is underway, and that guidance is in place. So we've talked about how those tracts existed, consisting of low-income, kind of economically distressed areas across the country. Congress was focusing on those zones, those areas for private investment, in considering and putting this program together. So as we stated, those zones have been designated. They'll retain their designation for 10 years, and those designations have been made across all 50 states, the District of Columbia, and the U.S. territories. So a lot of opportunities all across the country and in the territories for investment and taking advantage of the incentives offered under this program. For those of you, wanting to look and try to identify those areas in your jurisdictions that you're operating in, to determine where these tracts have been designated or identified. Many of you are probably already doing that, looking at interactive maps and focusing on specific data in your state or multiple states in which you operate. There's a really good interactive map here at the link that we've identified in the slides with the CDFI government site. You can type in, a specific street address and zoom right in and determine exactly if that property is located in the zone or not. Again, the thought behind this program, I think it's important to understand because a lot of times when you still have some vagueness or ambiguity when you're looking at particular areas of the statute or the administrative guidance or the regulations, and you're trying to make some determination as to how Treasury might interpret this or how this may play out for future purposes. A lot of what drives that is kind of the policy reason for the program. What was Congress intending to accomplish? I think it's important to understand that this is a program that essentially is encouraging economic development, private investment in low-income areas through tax incentives to those private investors. That is the underlying goal of the incentive. Is if Congress determines if we can give tax incentives to private investors for investing in specific areas of the country, we will generate and encourage economic development in those areas. The reason that we're focusing on capital gain and not just any type of investment, but again, these incentives are tied specifically to capital gain investment, not just ordinary income or other sources of income, is that the data that was available leading up to and as they were discussing this initiative and as it was getting incorporated into the tax reform package was there's over $6 trillion of unrealized capital gain toward the end of 2017 that taxpayers were essentially just sitting on. That the economy had ticked along since the recession at a fairly positive trajectory, and that continued growth in the economy had led to pretty substantial appreciation in assets that taxpayers held. So you had this unrealized gain, appreciated assets that were sitting out there, and Congress wanted to find out if incentives were offered that both encouraged or incentivized the accessing of that capital or lessened the tax blow of accessing that capital, but then also incentivized the reinvestment of that capital into distressed areas. Could that stimulate and spur economic investment and growth in these distressed areas? So that's the basis for the Opportunity Zone tax incentive. And so what are those incentives? Well, there's essentially three, two of them related in one kind of the home run that most people are attracted to. The initial is focused on taxpayer. We want to motivate you to access that unrealized capital gain. Well, taxpayer generally doesn't want to do that because they don't want to have a tax bill that goes along with having to report that gain and recognizing that income. So the initial tax incentive, the first incentive that the program offers, is a temporary tax deferral. I say temporary because it is not permanent. It is not like a 1031 exchange where you sell property and roll the proceeds from the sale of that property into other qualifying property, and that gain is deferred until such time as you may sell that replacement property. Here, the deferral period will end December 31st, 2026, or if there's an earlier sale of your investment in the Opportunity Zone Fund, will end December 31st, 2026. So to the extent that taxpayer recognizes gain, reinvests it into a qualified opportunity fund, and holds that investment in the fund, even if that taxpayer does not sell its interest in the fund prior to December 31st, 2026, when that deferral period ends, taxpayer is going to have to recognize that deferred gain and pay tax on it. So the first incentive is taxpayer gets the temporary tax deferral. To lessen the blow of that recognition of the deferred gain, the second incentive is that the taxpayer, based on the hold period of their investment into the Opportunity Zone Fund, can get a step up in their basis in that investment. So, when you think about you're acquiring Apple stock, you pay $1 million for Apple stock. That $1 million is your cost basis in that stock. So if you sell it 2 years later for $3 million, your basis is $1 million, your sale price is $3 million, you have $2 million of gain. Because your investment in the Opportunity Zone Fund is being made with tax-deferred dollars, IRS says that your initial investment in that fund has a zero basis. So even though you might invest $1 million of deferred gain into an Opportunity Zone Fund, your basis is zero initially in that Opportunity Zone Fund investment. So the second incentive states that you invest in Opportunity Zone Fund, you hold that investment for at least 5 years, then you get a 10% basis step up. Which essentially means when if you've invested $1 million, your basis would increase to $100,000. You hold an additional 2 years, so you hold 7 years. You get an additional 5% basis step up. So after 7 years, you would have a 15% basis increase in that investment in the fund. So if you invested $1 million, you hold that investment for 7 years. You have $150,000 of basis now in that investment, so that when the $1 million of deferred gain it has to be recognized by the taxpayer at the end of the temporary tax deferral period, a taxpayer would only have to recognize 85% of that because of that 15% basis step up. So it helps lessen that blow a little bit of the recognition of that deferred gain. The final incentive and the real home run in most people's eyes is to the extent you make that investment in the Qualified Opportunity Fund, fund acquires qualifying property, you hold that investment in the fund for at least 10 years, so you've gone through the 7-year period, you've gotten the basis step up, the deferral period ends, you recognize that original deferred gain and pay the tax on it. Any additional appreciation on that original investment, so you invested $1 million, after that 10-year hold period, any appreciation on that original investment is completely tax-free. So if in year 12, after the 10-year hold period, you sell your interest in the fund, and say you sell it for $3 million, you originally invested $1 million, that $2 million of appreciation is completely tax-free. You essentially are allowed to elect to step up your basis in that investment to the fair market value at the time of sale, which if you're selling it for $3 million would be $3 million, and that would mean you have no gain at that point. So those are the three incentives under the program. Again, the one that a lot of people get kind of starry-eyed about is that permanent gain elimination if you're able to hold the investment for at least 10 years. Just some important dates to remember under the program then is that With respect to qualifying property, and we'll get into a little bit about what that means, or a qualifying lease, you have to acquire that property after December 31st, 2017. So a lot of the qualifying property that a fund can invest in or an underlying opportunity zone business can invest in has to have been property acquired after December 31st, 2017. So to the extent some of you have property that you already own in an opportunity zone, it may present some problems, and there's some planning we can do to address those, but you definitely will have to address those issues in putting together or structuring a fund. We talked about the 7-year hold period, that you get an additional 5% basis step up if you hold the investment in the fund for at least 7 years. Again, remember, the temporary deferral period ends December 31st, 2026. So you count back 7 years from December 31st, 2026. In order to get the full benefit of the 7-year hold, that additional 5% basis step up, you would need to invest in a qualified opportunity fund by December 31st of this year, December 31st, 2019. So again, unfortunately, because of the delay in Treasury getting guidance out to us through the proposed regulations, a lot of people sitting on the sidelines not knowing what to do. We do have kind of a compressed time frame at this point in which you would have to get an investment in a qualified opportunity fund in order to get the full benefit of the 7-year hold. There has been some talk. Senator Scott and Senator Booker may be introducing some legislation that would address just this issue of the temporary deferral period, perhaps pushing back that December 31, 2026 date 1 year, 2 years, to give additional time for taxpayers now that we have guidance from the IRS to move forward with investment. But at this point, in order to get that full benefit, the investment would have to be made by the end of this year. Additionally, to get the full benefit of the 10% basis step up, that 5-year hold period, you walk back from 2026, that puts you at December 31st, 2021, that you'd have to have at least 5 years within the temporary deferral period in order to make that investment. The December 31st, 2026 is when the temporary deferral period ends. So at that point, as we said, taxpayer would have to recognize the gain, the deferred gain from the original investment. That's even if the taxpayer has not sold its interest in the fund, has not sold any of the assets owned by the fund. It's just a recognition event that's going to occur regardless of the taxpayer's actions. With the basis step up, you would have that that 15% discount. So you're only recognizing 85% of that. Additionally, in order to make a qualifying investment in an opportunity zone fund, so that you'd be entitled to the 10-year hold period that gives you the permanent exclusion on appreciation, you would have to invest gains that were realized prior to December 31st, 2026. So the deadline in which you can invest in a qualified opportunity fund would be predicated on gains being realized prior to December 31st, 2026. So as we'll talk about, you have 180 days from the time period in which you recognize the gain to actually reinvest those into a qualified opportunity zone fund. So as long as those gains are realized before December 31st, 2026, then you would have 180 days into 2027 to make that last qualifying investment into a qualified opportunity fund. And still, you wouldn't get the temporary deferral, you wouldn't get the basis step up, but you would still at least be entitled to the 10-year permanent 10-year hold period for the permanent exclusion on appreciation. And finally, we learned in the first round of regulations that there is an end date. So if you invest in qualified opportunity fund and fund develops real property or fund acquires an interest in an operating business, there is a period in which then investor, to get that exclusion of appreciation, that exclusion on the gain and the appreciation on the initial investment. Investor would have to sell its interest in the Qualified Opportunity Fund, or we received guidance in the second round of regs to make that process easier, because there was some pushback to the first round saying, if we're limited to just selling, if investors are just limited to selling their interest in the fund, they may have a limited market for that. Purchasers most likely will want to acquire the assets of the fund, not the equity interest in the fund itself. So the second round of regs made it clear that after the 10-year hold period, the fund itself could sell its assets and elect to step up its basis in the asset itself. So essentially, it's no gain then flowing out to the investors from the sale of that asset. So before December 31st, 2047, either investor has to sell its interest in the fund, elect to step up its basis in that interest to get the exclusion on appreciation, or fund would have to sell assets owned by the fund and elect to step up their basis in those assets. One of the structures that we've had with respect to a lot of these transactions is having the Qualified Opportunity Fund owning an underlying Qualified Opportunity Zone business entity, and there's a variety of reasons as to why we've done that, and we'll get into it later. But unfortunately, under the second round of regs, this ability of the fund to elect to step up its basis in an asset after the 10-year hold period, that election does not apply under the current language of the regs to an underlying Opportunity Zone business. So if the underlying Opportunity Zone business that's owned by the fund owns assets, you may have some gain recognition if the underlying business is selling those assets. That's assuming Treasury doesn't provide us any more guidance, making it clear that perhaps that asset election will apply to the underlying business. But at this point, only the fund is permitted to make that step up after the 10-year hold period with respect to assets that the fund owns. So just keeping in mind, what does this look like? You have, investors. They recognize capital gain from the disposition of assets. They sell a business. They sell real estate. They sell stock. They've recognized gain. They have 180 days to invest that capital gain in a Qualified Opportunity Fund. And then fund itself has 180 days, then 6 months to deploy those proceeds into qualifying property. And so that can either be done through the acquisition of an equity interest in the Qualified Opportunity Zone business entity, partnership interest, membership interest, or stock, or the Qualified Opportunity Fund can acquire Qualified Opportunity Zone business property directly, could acquire real estate, equipment, other tangible property utilized in a trade or business activity in the zone. So in this diagram here, you see fund could invest in this real estate development project, could invest in an Opportunity Zone, Qualified Opportunity Zone business, the partnership, an LLC, that then acquires real estate for development as a multifamily rental or commercial development, or the fund could actually acquire that property directly and develop it as well. Keep in mind, if you have the two-tier structure, the intermediary tier, the Qualified Opportunity Zone partnership there cannot be a disregarded entity for federal tax purposes. It would have to be an entity recognized as a partnership or corporation. The same with the Qualified Opportunity Fund. That entity cannot be a disregarded entity, a single member LLC. It has to be an entity recognized as a partnership or corporation for federal tax purposes. So just to bring all this together and tie a bow on it, you have a timeline here that outlines, you have the gains that are rolled into the Opportunity Fund within 180 days of the sale of the asset. After year 5, you get the 10% basis step-ups, that eventual recognition of the deferred gain is going to be reduced by 10%. After year 7, you get an additional 5%, and increases it to 15% reduction. And then you have there, after December 31st, 2026, investors going to have to recognize 85%, assuming they've were able to get the investment in 2019 and held for the entire 7-year hold period. They would have to recognize that deferred gain, or 85% of it, after December 31st, 2026. And then after the end of the 10-year hold period, the investor could sell its interest in the fund itself and elect to step up its basis in the fund interest, or the fund could elect to sell assets and step up their basis in those assets, generating a sale or disposition where the appreciation on that asset is completely tax-free. Just a nice little summary of the timeline there. So, what are some technical issues related to that? What type of gains are eligible for deferral? What type of gains can be invested and constitute a qualified investment? Again, I can't stress this enough. We continue to have conversations even now with clients and investors who think they can just put ordinary income, any type of funds, into a qualified opportunity fund. And one of the pitches is that, well, we recognize we don't get the deferral, but we'll still get the 10-year exclusion on appreciation. Well, that's not the case. To be entitled to any of the 3 tax incentives, you have to be investing with deferred gain. That doesn't mean you have to trace the dollars directly to the liquidation of an asset or disposition of an asset that generated the gain. You just have to have capital gain that you are seeking to defer in an amount that's either equal to or in excess of your amount that you're investing in the qualified opportunity fund. So any asset that generates capital gain for federal tax purposes, that gain can be utilized and invested and deferred through a qualified opportunity fund investment. So it could be, again, sale of a business, sale of stock, sale of real property. One issue to point out there is the proposed regulations make it clear that Section 1231 gain qualifies. For those of you who aren't familiar, it's essentially just the sale of a business asset used in a trade or business. Sometimes there's some component of that's the ordinary gain. Some component of that could even be capital loss. But to the extent that you have Section 1231 capital gain, that amount would also qualify for purposes of investment in an opportunity zone. To the extent that a taxpayer chooses to make an investment of, say, there's $1 million of capital gain and $1 million of just ordinary income, they want to make a $2 million investment in an opportunity zone fund, that can be done. The IRS will simply treat that investment as a mixed fund investment, and half of the investment will be treated as a qualifying investment entitled to the tax incentives, and half of it will be treated as a regular investment in any type of entity that's not entitled to the tax incentives. With respect to gains generated out of a partnership or other pass-through entity like an S corporation, there was some concern, say I'm a member of an LLC or I'm a shareholder in an S corporation and we have 15 different shareholders, so we've got 10 different members, and none of us are ever going to agree on where to invest or whether we want to defer. Or you may not be aware that the activity of the partnership or the pass-through entity has generated any gain until you get your K-1 in the following tax year. So the IRS recognized and addressed in the first round of proposed regulations that to the extent that the entity in which the gain is generated, whether it's a partnership or S corporation or trust, other type of pass-through entity, the entity itself can elect to defer that gain. They have 180 days from the date of recognizing the gain to reinvest that gain in a qualified opportunity fund and defer that gain. But if the entity chooses not to defer, then the individual owners or beneficiaries that are the receivers of that gain have 180 days from the end of the tax year to choose to reinvest that gain into a qualified opportunity fund and get deferral treatment. To the extent that individual owner wants to accelerate that timetable, individual owner could choose to elect the partnership's date for that investment, but owners do have kind of a relief provision here. So if the 180-day period passes for the pass-through entity, then 180 days from the end of the tax year, the individual owners have the ability to elect to defer their portion of that gain. A lot of people talk about, this sounds a lot like a 1031 exchange, or this reminds me of a 1031 exchange. Just kind of want to point out how it's different. With respect to a 1031 exchange, as many of you know, in order to get the deferral treatment with respect to the gain, you have to reinvest the entire proceeds of the sale of the property into other qualifying replacement property. Any amount that's withheld or not invested could end up in taxable boot in the hands of the owner. So if you sell property for $4 million, you got to put all $4 million into replacement property. With an opportunity zone investment, you only have to reinvest the gain. So if you sell real estate for $4 million and you paid $3 million for it, you only have to reinvest the $1 million of gain in order to defer that gain. The other $3 million of cost basis, you can do whatever you want with it, and it won't affect the deferral treatment of that $1 million in gain. So to the extent that you have, appreciated assets, and you're wanting to kind of readjust and reevaluate your portfolio and move potentially assets in different directions, this gives you the ability to sell an asset, defer the gain, but use then the basis proceeds to invest in other property. In a 1031 exchange, after tax reform, you can now only go specifically from real property into other qualifying real property. With respect to an opportunity zone, as we discussed, all capital gains are eligible. So you can sell Apple stock, generate a gain, invest in a qualified opportunity fund that then acquires real estate and develops it. You could sell your business. You could sell other real property. Whatever asset that upon disposition generates capital gain, that gain is eligible for investment and deferral in opportunity zone. 1031 exchange, there's some complications, and they have to get a third party involved, the qualified intermediary that holds the proceeds and transitions those proceeds into replacement property. On the opportunity zone side, you don't need a qualified intermediary. You don't need any approval with respect to your opportunity zone fund entity. Taxpayer is able to self-certify with Treasury that they want to treat, this LLC or this corporation or this limited partnership as a qualified opportunity fund, and they don't have to have a response from Treasury. They just file Form 8996 self-certifying the entity as an qualified opportunity fund with Treasury and treat it as such moving forward. With respect to 1031 exchange, you do have deferral of the gain until you dispose of the replacement property. On the opportunity zone fund, that deferral period, again, is temporary, and you will ultimately, if you don't otherwise dispose of your interest in the fund, have to recognize that deferred gain, or at least 85% of it, after December 31, 2026. On the 1031 exchange, there's some flexibility with selling to and buying from related parties. As we'll talk about on the opportunity zone side, there's some pretty substantial restrictions with respect to related party transactions. So what is a qualified opportunity fund? I mean, I know that can scare people. They think about significant hundreds of millions of dollars portfolio, fund managers, fees, complicated structure. It can be that. I mean, there are national funds that we've worked with that have hundreds of millions of dollars, and funds raised, looking to deploy them in the qualifying projects all across the country. But it doesn't have to be that. The Qualified Opportunity Zone Fund is simply an investment vehicle that is formed for the purpose of investing in qualified opportunity zone property. It could be a partnership between you and your business partner, between you and other business associates or friends. It's simply an entity that's formed for that purpose of investing in qualified opportunity zone property. We have a variety of clients that have very complex structures, and they're seeking and soliciting outside investment in those funds. But then we also have individuals that had a piece of property they've always had their eye on in a particular downtown business district. They have some gain, and they form a fund with spouse or form a fund with business partner and acquire the property and move forward with development consistent with the guidance that we have. So it can be a variety of different things. Don't want the term opportunity fund to scare anyone off. It's simply the entity that's formed to deploy those gain proceeds into qualifying property in the opportunity zone. The primary restriction on an opportunity fund is that at least 90% of the assets that the fund owns have to consist of qualified opportunity zone property. Again, generally that's going to be, as we'll talk about, an equity interest in an opportunity zone business or tangible property utilized in a trade or business activity within the zone. That 90% test is evaluated at 2 points in the fund's tax year. Initially, it's going to be at the end of the first full 6-month period that the fund is operating within the tax year. And then again, at the end of the tax year would be the second testing period. Then those 2 dates are averaged, and to the extent that amount is equal to or in excess of 90%, then the fund has satisfied that 90% test. One of the concerns that was raised in the initial organizing of funds is that you may have a fund that started getting investments in January of 2019, so that first test date is going to be June 30, 2019, and say investments are staggering in, and you get a big wave of investments early June of 2019. Well, you're up against that 90% test date. How are you going to deploy? You don't have enough time to deploy those investments in the qualifying property. The second round of regulations the Treasury recently issued made it clear that to the extent that you've received funds in, you have 6 months to deploy those funds. So if you have a test date June 30 and you have a significant amount of investment that comes in June 1, you have 6 months to invest those proceeds. They wouldn't count against you for purposes of the 90% test at that initial June 30 test for that fund. Again, there are 3 types of property that a qualified opportunity fund can invest in. The first 2, qualified opportunities on stock, qualified opportunities on partnership interests. Those are just equity interests in opportunity zone business entities operating within the zone. And again, qualified opportunities on business property, which is going to be tangible property, and most likely, what we've been seeing in our activity, that's usually just going to be real estate located in the zone. One important point to point out, we have a lot of clients that want to form a kind of a fund of funds. You cannot have a qualified opportunity zone fund acquire an interest in another qualified opportunity zone fund. The fund can only invest in the 3 types of property identified here in Internal Revenue Code Section 1400 Cap C-2. With respect to stock, I just want to point out that stock, we talked about the important dates, December 31, 2017. There we see it again. All qualifying opportunity zone property, in order for it to qualify, has to have been acquired after December 31st, 2017. So that's going to apply to stock, partnership interest, membership interest, tangible property, real estate. Has to be acquired after December 31st, 2017. At the time that it's acquired, the corporation or the LLC that the interest is acquired in has to be operating as a qualified opportunity zone business or was formed for that purpose. And then during substantially all the time that the fund holds the equity interest, whether it's stock or membership interest, the entity has to qualify as a qualified opportunity zone business. Originally, we didn't know what substantially all meant in this context, but the most recent round of regulations defined substantially all in this context to be 90%. So for at least 90% of the time that the fund holds an equity interest in an entity, that entity has to satisfy what it means to be a qualified opportunity zone business. With respect to qualified opportunity zone business property, this is tangible property, again, that qualified opportunity zone fund or an underlying qualified opportunity zone business entity purchases after December 31st, 2017, and that's used by the fund or the business in a trade or business operating in a qualified opportunity zone. Not only does it have to be acquired after December 31st, 2017, the fund or business has to use that property. At least 70% of its use has to be within the qualified opportunity zone. So, they're recognizing a little bit of flexibility that there may be some equipment, some property that would be utilized outside the zone in a particular trade or business activity, but substantially all, 70% of that use has to be confined to within a qualified opportunity zone. Another requirement with respect to qualified opportunity zone business property is that the original use of that property has to begin, the original use of that property in the zone has to begin with the qualified opportunity fund or business. To the extent that that original use does not commence with the zone or with the business or the fund, then there is a requirement that they substantially improve that property. And what that means is that the fund or the business has to make significant capital improvements to the property in an amount that exceeds the fund or business's basis in that property. Stated more simply, you basically have to make improvements to the property in excess of the purchase price. So you can't just acquire commercial building in opportunity zone, think, this generates a lot of rental income, I'll, give it a paint job and put a new awning on the front, and this will be great. In 12 years, I'll sell it, and the appreciation will be tax-free. That doesn't work. To the extent that you're acquiring property that's already been used or being used in a opportunity zone with respect to real property, that's generally going to be all real property, has been used in some form or fashion, you have to substantially improve that property. Again, thinking back to the purpose of this program is long-term capital investment in these distressed areas. They don't want to encourage land banking or acquisition of property for investment purposes. They're really trying to focus on substantial and significant investment in these areas. So to the extent there's no original use, you have to substantially improve. IRS has provided some really good guidance in the regs and in a revenue ruling that was issued with the first round of regulations that says, in the context of acquiring real property that has a structure on top of the land, the value of capital improvements that have to be made to substantially improve that property, you only have to focus on the portion of the purchase price that can be allocated to the structure itself. So if you acquire real property for $1 million, $600,000 of that is allocated to the structure, $400,000 to the underlying land. You only have to make improvements in excess of $600,000 to substantially improve the entire property. You don't have to include the value of the underlying land in that substantial improvement analysis. With respect to original use, the statute in the first round of regs did not define what that meant. I mean, everyone kind of had some ideas as to what that would mean, but we really didn't have any clear guidance from the IRS. The second round of regs have made it clear that original use means such use that the property is placed into service for purposes of depreciation or amortization for federal income tax purposes, or such use that would require a taxpayer to depreciate or amortize that property for federal tax purposes for the first time within the zone. So if it's equipment and it's been used in another area and depreciated by another taxpayer outside the zone, and it's used property and you're bringing it in the zone for its first use, its first depreciation, being placed into service in the zone, that would qualify. But to the extent you're acquiring a commercial structure that's been depreciated previously, then you're going to have to substantially improve. You don't have the original use of that property in the zone. This has led to some funds focusing on projects that are near or almost complete. Perhaps the certificate of occupancy hasn't been issued yet, so you've got a brand new construction that's never been depreciated, and you're seeing some funds now going in and acquiring those properties prior to the issuance of the certificate of occupancy, prior to the taxpayer ever placing the property into service, and taking the position that original use begins with them as the first party to acquire and depreciate the property and place it into service. With respect to unimproved land, so we talked about how focusing on capital improvements, you only have to focus on, if there's a structure on that land, you only have to focus on improving the structure, not the underlying land. That led to the question, well, what if I'm buying vacant or unimproved land? How do I substantially improve that? Well, the second round of regs make it clear that unimproved land does not have to be substantially improved. There's not an original use requirement. There's not a requirement to substantially improve it. You could acquire unimproved land and it could be considered qualifying property as long as the property is used in a trade or business activity of the fund or an underlying qualified opportunity zone business. Really no explanation as to what that means other than they do make it clear in the regs that land banking is prohibited. You can't just acquire a bunch of land in the zone for investment purposes. In addition to that, there has to be at least some capital improvement that recognizes to the property or some increase to the economic output of the property. So one example in the regs is if you had a farming operation within the zone, you acquire that farming operation and you just continue doing the same farming activity, that would not qualify. That's not an increase in the economic output from its prior use. We've talked about the substantial improvement requirement. One thing to point out is that substantial improvement has to be done over a 30-month period from the acquisition date of the property. So to the extent that you're acquiring property in the zone, the original use does not commence with your fund or your underlying qualified opportunity zone business, that property will qualify as qualifying property as long as you substantially improve it within the 30-month period beginning at the date that the property is acquired. So you do have a period of time in which to improve that property and make sure that it satisfies that test. One restriction on qualified opportunity zone business property is the related party restriction that we referenced or alluded to earlier. The property has to be purchased after December 31st, 2017. The definition of purchase in the statute ties back to another section of the Internal Revenue Code that limits related party transactions. The Opportunity Zone statute makes that restriction even stricter by rather than focusing on a 50% common ownership, focuses on a 20% common ownership. So to the extent that there's common ownership of 20% or more between buyer and seller of a particular piece of property, it will not qualify as qualified opportunity zone business property. So again, to the extent you currently own the property and you owned it prior to December 31st, 2017, and you want to participate in an opportunity zone fund or opportunity zone business that's going to acquire that property and develop it, if you own 20% or more of that fund, you may have some related party issues to address. Another important aspect of the regulations or of the program itself is the ability to invest in operating businesses. That activity has kind of been stagnant because there wasn't a whole lot of guidance as to what that looked like or how you would invest in a operating entity. How do you substantially improve an operating business? Does the business have to qualify as an opportunity zone business before you invest in it? A lot of questions that need to be answered. And the second round of regulations have provided us with some more foundation of what it means, what it looks like to invest in a qualified opportunity zone business. One of the issues was there's a restriction in that a qualified opportunity zone business has to earn or derive at least 50% of its gross income from the active conduct of a trade or business in a qualified opportunity zone. So a lot of people thought that geographic limitation may be extremely restrictive, would prohibit or discourage investment because people thinking you've got to have activity outside the zone as well to be a successful business. And how would that 50% test be interpreted or enforced? The second round of regs provided 3 safe harbors and a facts and circumstances test for determining what it means to derive 50% of the business's total gross income from trade or business activity within the zone. And it gives a lot of flexibility. I think there's you'll see in looking through and reviewing those restrictions. One is based on whether 50% of the services by hours are performed within the zone. The second test focuses on whether 50% of the services performed based on compensation paid are within the zone. So, the example given in the slide there is you could have a startup business and it has a service center outside the zone where you have maybe hourly waged employees at the service center, but you've got salaried management and operational employees at the headquarters campus within the zone. You may have more than 50% of your total compensation being paid within the zone, even though 50% or more of the hours may be performed outside the zone, and you would qualify. And then the conjunctive test there, focusing on some combination of the tangible property that the business owns and the management and operation functions located in the zone are necessary to generate at least 50% of the gross income, then that would qualify as well. And the example that the regs give is if you had a landscaper who's headquartered in the zone, their operational, billing, management is all in their OZ headquarters, and they're storing their equipment in the zone on a daily basis, that would qualify under the conjunctive side. Some other areas to touch on here in closing. Again, I think generally the first and second rounds of regs have been, pretty much, and for the most part, taxpayer friendly. I think we've had a lot of surprise that there's been a real desire on the part of Treasury to make sure that this encourages and enables investment, within the context of their statutory parameters. But some very, taxpayer-friendly provisions. Just want to tick through a little bit here. What some of those provisions are. One of the questions we had initially was, how leasing, real property would be considered from an active trade or business standpoint. A lot of times we're structuring real estate investments where you have the opportunity zone fund, You may have a joint venture opportunity zone business entity underneath that fund because you have developer that wants an interest in that entity, as well as the fund that has an equity interest in that entity that then is acquiring the real estate and developing it. There was some concern whether the leasing of that property would be a trade or business activity for that opportunity zone business entity. The second round of regs make it clear that the trade or business case law and guidance that's out there as to what constitutes a trade or business for purposes of Internal Revenue Code Section 162, that all that would apply in the context of evaluating a trade or business activity for opportunity zone purposes, but also emphasizes that the leasing of real property will be considered a trade or business activity in the OZ context only. So it seems to provide a little bit of relaxed restriction under 162 with respect to leasing activity, but does make it clear that simply entering into a triple net lease would not be considered an active trade or business. So in that instance where the opportunity zone fund or business entity is purely passive, has no involvement, is just leasing and through a triple net lease structure the property, that would not be considered an active trade or business. The business entity or fund has to have some operational or management role with respect to the leased property. One of the concerns with respect to the development of real property was if you had proceeds sitting in an opportunity zone business or in a fund, then those proceeds were dedicated to the development costs, construction costs, that somehow that would be considered a non-qualifying asset while it was just sitting there in the fund or the business. Remember, the fund has to have at least 90% of its assets consisting of qualified opportunity zone property. A business, I think I glossed over this, opportunity zone business, at least 70% of the tangible property owned or leased by the business has to be qualified opportunity zone business property. So you have a little bit of more flexibility at the business level as opposed to the fund level in meeting those property ownership requirements. But the concern was you bring in $10 million, you acquire property for $1 million, you've got $9 million of development costs. That money's just sitting there in the fund or the underlying business. It's going to count against or violate those thresholds. In addition, opportunity zone business has a restriction on the amount of non-qualified financial property that it can own. Only 5% of its assets can consist of non-qualified financial property, which is cash or equity, securities, other types of non-qualified financial assets. So it's concerned that you would violate potentially both of those tests. The first and second round of regs made it clear that at the opportunity zone business level, not at the fund level, but at the business level, to the extent that you're accepting investment proceeds into the business consistent to a written plan as to how those proceeds will be used to acquire and develop real property, or will be used in the startup costs and formation of the opportunity zone business, that those proceeds will be treated as reasonable working capital of the business, would not go against the 5% restriction as long as those proceeds were distributed consistent with the plan over a 31-month period. So you do have the ability to bring proceeds into the opportunity zone business entity consistent with a written plan, and those will be treated as reasonable working capital of the business for a 31-month period as long as they're deployed consistent with that plan. Now, one issue with that is that we still, under the guidance, you don't get that working capital safe harbor at the fund level. It's only at the underlying opportunity zone business level. With respect to real property that's straddling a zone boundary, say some part of the parcel or property may be outside the zone and some part within the zone, the second round of regulations make it clear that all the property will be considered in the qualified opportunity zone if the cost of the real property inside the zone is greater than the cost of that property sitting outside the zone. One critical question was how can leased tangible property qualify? So if a business is leasing real property or leasing equipment, could that leased property qualify as qualified opportunity zone business property to meet either the 90% fund threshold or the 70% opportunity zone business threshold? The second round of regs that just came out made it clear that, in fact, leased tangible property can be treated as qualified opportunity zone business property if certain requirements are met. First, the lease has to be, again, we see this date again, has to be entered into after 12/31/2017. Substantially all of the leased property has to be used within the qualified opportunity zone. So to the extent it's real estate, it's likely all going to be located in the zone, so you would meet that test. The terms of the lease have to be market rate. The analysis conducted there under Internal Revenue Code Section 482 has to be consistent with market rate terms within the zone, other comparable property. There's no original use requirement with respect to leased property, so there's no requirement to substantially improve. And in addition, related party leases can qualify. So you remember in the purchase context, to the extent you're purchasing tangible property, it has to be purchased from an unrelated party. A related party lease can qualify as opportunity zone business property as long as there's no prepayment term for a period of use of the property in excess of 12 months. And in addition, to the extent that it's personal property, so you're leasing personal property from a related party, you have a requirement within 30 months of taking possession of that property to acquire additional qualifying property of a greater value than the leased property. So there's kind of this quasi-substantial improvement with respect to leased personal property from a related party. One issue that was important is the distribution of property, including cash, after, say some period with a real estate development, the development stabilized and the property's refinanced and then cash is distributed out in typical real estate transaction to the investors. That can occur here as long as those distributions are made after the first 2 years of the fund, and to the extent that the investors have sufficient basis so that the distributions that are made are not in excess of their basis in the qualifying investment, then those distributions will be proper and would not require some recognition of the original deferred investment. Keep in mind, again, because that initial investment is made with deferred gain, that the investor's basis starting off is zero. So there would have to be some other way that basis would be generated necessary to ensure that those proceeds, those distributions could be made, whether it's income being generated and allocated to create basis in the investors, whether there's qualified non-recourse debt that generates basis in the investors. There may be some issue there to the extent that you want to make distributions. You may not be able to where the investors don't have sufficient basis to offset those distributions. On the developer side, one of the questions that's been asked is can this be structured in such a way that the developer's profits interest could be sheltered within the 10-year hold period exclusion of appreciation. Unfortunately, for the developers out there, that's not the case. The second round of regulations make it clear that a profits interest partner that's getting a capital interest in exchange for their services is ineligible to receive the opportunity zone tax incentive. It has to be an interest in exchange for a deferred asset. It can't be in exchange for services. One important issue with respect to the sale of property owned by the fund, there was some concern that fund may need to liquidate for a variety of business reasons property during the 10-year hold period. And there was some concern that fund selling assets may somehow blow the 10-year hold period or violate the structure in some way to the investors in the fund. The second round of regulations make it clear that to the extent that Qualified Opportunity Zone Fund sells Opportunity Zone business property that it owns during the 10-year hold period, those proceeds can be treated as qualifying property as long as they're reinvested into other qualifying property within a 12-month period. So, fund sells an asset, those proceeds will be treated as qualifying property as long as those proceeds are reinvested within 12 months to other qualifying property. However, I just want to point out that this provision does not shield the investors from any taxable gain that they would realize on that sale of property. So, we talked about after the 10-year hold period, fund has the ability on an asset-by-asset basis to elect to step up its basis on the sale of an asset owned by the fund. Before that 10-year hold period, Treasury interpreted their guidance under the statute to not give them any authority to make that sale tax-free. So to the extent there's gain on the sale of that asset during the 10-year hold period, the investors are going to recognize that gain and have to pay tax on it. But as long as those proceeds are reinvested, fund's not going to blow its 90% test. Investor will continue to hold its interest. The 10-year period doesn't have to reset. The fund can move on as it was. You might have a gain recognition event there for the purposes of the investors. And finally, an interesting point that a lot of people always were asking questions. We didn't have any guidance until the second round of regulations came out. Is what happens if investor dies? Does that blow the investment? And the 10-year hold period ends. They have to recognize gain upon death. The second round of regulations make it clear that the distribution of a qualifying investment in Opportunity Zone Fund to a beneficiary, either by the estate or through operation of law as an heir, is not an inclusion event. It doesn't require a party to have to recognize any of that deferred income into gain, doesn't blow or violate the investment in any way. And with that, I just want to be able to leave some time for some questions. And so to the extent we have any questions, definitely want to make sure that we address those. So I'm going to open the question pane. Let's see. Is there a handout available? So I want to make it clear that you will be able to have access to the presentation itself. We will provide a link through Charles Tassel and the National Real Estate Investors Association that you'll be able to play the webinar again. You'll have access to the audio, and you'll have access to the slides themselves. Going here to additional questions. Is calculation of the required improvement amount done by performing a cost segregation analysis at purchase? I think the question there would be to the extent that you were able to bring in some type of qualified appraiser. That's what I would recommend. That appraiser would be able to come in and say, this portion of the purchase price is allocated to the structure on top of the land. this portion of the purchase price is allocated to the value of the underlying land. I think an appraisal would be very helpful in that situation to be able to support your position should IRS come in and challenge potentially the allocation that you've made or the determination of what amount is required for substantial improvement purposes. Now, keep in mind, if you pay $1 million for the entire property, building and land, and you do $6 million of improvements, there's not a whole lot of risk there. I think you've more than met the substantial improvement requirement. But to the extent that you're right there on the line, I think you're going to want to make sure that you have some basis to support the position you've taken with respect to the allocation of amount to land and amount to structure. So I would recommend some type of qualified appraisal. But if there's some other way that you want to support that, again, keep in mind that that allocation is, if ever challenged by the IRS, you're going to have something to support the position that was taken. The next question is, what happens if the OZ tract is also in an enterprise zone or TIF, a TIF district? We're in the process of a variety of projects that have a TIF component to them. What other benefits, tax credits, TIF proceeds, municipal grants, government funding, financing from banks or other financial institutions. It's good to think about this as really another addition to the capital stack to your project. So if you're getting private investment of $1 million, you're getting TIF proceeds of $3 million, you're getting bank financing of $3 million, and you need an additional $4 to raise, you could raise that additional $4 through a qualified opportunity zone fund. It's just another source of capital for your project, another source of investment into the project. And so if it's in a TIF district, and to the extent you're able to access those proceeds from the municipality or other governing body, that's great. That's just an additional source of capital that you would have in that particular project. I would caution, as what we're learning in a lot of our TIF projects, is that tax reform that was passed at the end of 2017 has, in many instances, made TIF proceeds taxable to the parties receiving those proceeds. What was once considered to be a non-taxable source of basically a non-shareholder capital contribution from the municipality, under Internal Revenue Code Section 118, it was amended due to tax reform that makes a lot of TIF grants now taxable to the recipient. So just keep that in mind as you explore, how those deals should be structured and how those should be recognized. I had a nice comment by Charles Tassel there. Again, I know some of your comments and questions have been about whether the presentation is being recorded, whether you have access to materials. Again, all that will be made available later by Charles through a link that'll give you access both to the presentation and to the recording. Another question here is, can the Opportunity Zone Fund invest a portion of the fund in the purchase of real estate and another portion to the rehab of the same property? To the extent that I don't know necessarily, I guess, why that structure would be implemented, but I guess you could have fund I mean, the concern I would have, just to drill down to the basic concern, is that the fund is going to have to own an asset that is a qualifying asset for purposes of the 90% test, or to the extent fund invests in an underlying opportunity zone business entity that acquires the asset, at least 70% of the property owned or leased by the business is going to have to be qualifying property. So if you break out the real property from the improvements into two separate entities, you risk the real estate in the hands of the fund or the business potentially not qualifying because I would want the entity that acquires the property to also be involved in substantially improving the property, and I don't know that you get any real benefit if you had two entities under the same fund, one owning the property, one owning the improvements. I'm open to suggestions there, but I'm worried that might lead to the entity that's just holding the real estate and not substantially improving that real estate not getting the credit for that being qualified property in the hands of that entity. We have another question here. Is there a process to register my company to participate in opportunity zone type investments? Any fees to participate? One thing I would point you out to is, depending on the state you're in, a lot of the states are really getting out ahead of this. I know we've dealt with a variety of different locales, working with them and evaluating how they should position themselves or how they should solicit or act on behalf of trying to get investment into the opportunity zones within the state. So a lot of states have a outward-facing OZ page, and even some local jurisdictions, depending on the size of the city, have an outward-facing OZ page where you can list with the state or the city as an entity that's seeking investment. There's no fee to participate, and so they'll list you on that platform so that people can look through various projects in the zone that are looking for investment. And so I would recommend you check with the state that you're located in, and perhaps if you're in a larger city, the city as well, to see if they have a platform such as that you can list your project or property. There are also other for-profit entities that are trying to develop platforms to list particular projects. One I met at a recent Opportunity Zone conference is a company called InvestReal, and that's exactly what they do for developers and project sponsors. They provide a platform that you can list and identify your project seeking investment. And I don't believe from the project standpoint that they have any fee to participate, but I may be wrong. So I would recommend you looking around. Check first with the state and locale in which you're in, see if there's an outward-facing page that you can list your information. But then also there are companies like InvestReal out there doing the same. Let's take a few more questions here. Would a land trust be considered an OZ fund? So one issue with respect to an existing land trust, the entity would have to qualify. An existing entity can qualify as an opportunity zone fund as long as it meets the requirements of an opportunity zone fund. So if you had a land trust that owned property outside an opportunity zone, most likely that's not going to qualify, and so you'd have a situation where the existing trust, based on its holdings, it could not qualify. In addition to that, I mean, the statute's pretty clear. Opportunity zone fund has to be an entity that's treated as a partnership or a corporation for federal tax purposes. So I think it'd be much cleaner, much more in line with the guidance if you had or formed a partnership or LLC, a corporation, to act as your Opportunity Zone Fund entity, so that you can be assured that you're going to qualify from the initial formation as an entity organized for that purpose, and then you can acquire qualifying assets to ensure that you remain in compliance going forward. Another question, can I buy a business with an OZ fund located outside of an OZ at time of transfer, then move it inside an OZ within a few months and have that qualify? So I think, in that particular context, that is something that could potentially work. I think you would want to use the OZ fund to raise the necessary capital to transfer the business and improve the business, and then you probably want to form a new LLC or partnership or corporation that would be the operating entity within the zone, and then you could put those OZ fund proceeds into the new business, and then use those proceeds in the hands of the new business to acquire the assets of the business operating outside the fund. And then you would have new real property to the extent you're leasing new property or you're acquiring property in the zone and building that out. You have equipment and other assets that you're moving into the zone. Their original use would be in the zone. Your business activity would be located and headquartered in the zone. So I think to that extent, then you would have a new business within the zone that would qualify. And remember, we talked about the reasonable working capital safe harbor. That's a 31-month window that, as long as those proceeds are coming into the Opportunity Zone business entity, pursuant to a written plan as to how those proceeds will be utilized in the growth and development of the business, then it's reasonable working capital of the business moving forward. So I think I would recommend, just from a structural standpoint, you form a new entity that's going to be operating in the zone. You fund that entity, and then it acquires the assets of the old business and begins operations in the zone. Another question, is there any restriction on foreign investment or types of investors into a qualified Opportunity Zone fund? The investors, the primary restriction, it just has to be any investor that would recognize capital gain for U.S. income tax purposes. So you've got U.S. taxpayers that are able to recognize capital gain. So it could be partnership, corporation, S corp, trust, any entity that's recognizing capital gain for federal tax purposes that can seek to make a deferral election. You cannot have foreign investors in a qualified Opportunity Zone fund. It would only be U.S. taxpayers, U.S. entities recognizing capital gain in the United States. What stipulations exist where or how capital gain funds must be held until a new qualified opportunity is secured? There's no restriction on where the funds may be held. So if I understand this right, if you sell a business, it generates capital gain. You could hold those proceeds in an investment account, in a mutual fund, in a money market account. You just have 180 days from the date on which you recognize the gain to reinvest a similar amount in a qualified opportunity fund in order to get the deferral treatment. So you could have, it doesn't have to be, it's not traceable either. You don't have to have the exact funds that were received from the disposition of asset invested into the Qualified Opportunity Fund. You just have to have an amount of deferred gain that you are then looking, the amount of capital gain that then you're looking to defer, and so you're making a qualified investment in an opportunity fund in an amount equal to or exceeding the amount you're seeking to defer. So you could hold those proceeds however you want. You could invest it in something else. And in fact, if you wanted to borrow funds to fund your investment in the Qualified Opportunity Fund, you could do that. You just have to have a gain, and you have to have an investment of an amount equal to the gain you're seeking to defer. Once they're in the fund, and the fund has the 6-month period in which to deploy in the qualifying investment, the regulations make it clear it has to be held in cash or cash equivalents. So that could be a money market account, it could be cash, it could be publicly traded securities. It has to be some liquid investment that's a cash or cash equivalent from the perspective of the IRS. So that would be the restrictions on holding the funds either at the Qualified Opportunity Fund level until that business or real estate acquisition is identified, and those funds would be deployed from the fund into that qualifying property. Well, I think that's the last question. Again, appreciate we ran a little bit over. I apologize for that and want to be respectful of your time. Oh, we got one more question. Does the full amount of a specific capital gain need to be reinvested, or can you invest just a portion? So just to put this into a hypothetical, you sell your business, it generates a $5 million gain. Do you have to invest the entire $5 million, or can you just choose to invest $2.5 million into a Qualified Opportunity Fund? The answer is you can invest whatever amount of that gain you want to defer. So if you have $5 million of gain and you invest $2.5 million, you're only going to get the deferral treatment with respect to that $2.5 million. The other $2.5 million, you're going to have to recognize as income in the year that you receive the gain, or recognize the gain and pay tax on it. So you don't have to invest the full amount. You can invest a portion of it. It's only that amount that you're seeking deferral treatment. So if you want to pick up $2 million of the $5 million in income and invest $3 million and defer, you can do that. It's completely up to you as the taxpayer. All right. Well, thank you all so much. My contact information and contact information of other people that are participating in our Opportunity Zone team here at Frost Brown Todd are there. We're kind of the tri-leaders of our team. We're, again, a multidisciplinary team. And to the extent you have any questions, feel free to reach out to us directly. And I know really appreciate Charles Tassel and the opportunity he provided for us to connect and have this dialogue, and really enjoyed presenting and discussing this issue with you all. And again, if you have any questions, don't hesitate. Feel free to reach out to me or a member of our team directly. We'd be happy to talk with you. Thank you, and have a great Tuesday, and enjoy the rest of your day.